A hedge fund allocation in your client's portfolio makes sense in this current investment regime. October saw further deterioration in market sentiment with rising geopolitical tensions. Another concern was the rising US debt supply, pushing long-term yields above 5%. Last month, the MSCI World Index was down 3%, and since the peak in July, global equity markets lost 9.7%. Despite this correction, markets are still up for the year. A resilient economy, especially in the US, surprised many investors and made the soft landing scenario the most likely one. Overall, corporate earnings have been strong. Nevertheless, looking behind the surface, the situation looks potentially more challenging. The MSCI World Equally Weighted Index is down 1.8% this year. Investors are realizing that rates could remain higher for longer. This chart shows the evolution of the US 10-year bond yield since 1990. We had a great bull market for more than 30 years, and the 10-year went down from 9% to less than 1% when the COVID pandemic hit. Following the huge liquidity injections made by central banks, inflation started to rise in 2021, and central banks started to raise rates again. The cost of capital increased significantly over the last 18 months. Since then, market participants have tried to adapt to this new reality, but the impact on economies and corporates is just starting to be felt. What could we expect from hedge funds in this context? Short-term, long-short equity managers are defensively positioned and making money on shorts. Global macro managers are up, playing the steepening of the yield curve. Longer term, looking at the chart, historical data shows that hedge fund managers perform best in higher interest rate regimes. During the period between 1990 and 2007, hedge funds outperformed market by 3.2% on average. Our selection of hedge funds even outperformed markets by 6.4%. Since 2008 and the great financial crisis, rates have remained below 4% and hedge funds underperform markets. Our selection of hedge funds underperform markets by 2%, even if the result is clearly better on a risk-adjusted basis. Now the situation has changed, and the 10-year, which recently reached 5%, could remain above 4% for some time. Inflation is likely to remain higher, and huge deficits are expected going forward with the combination of deglobalization, energy transition, the US elections, and the lack of natural buyers. Hedge fund returns are a function of dispersion in equity markets, and higher rates help separate the winners from the losers. In addition, short-term zero rates had neutralized one of the key sources of returns for the strategy. Today, with 5% rates, just because of keeping a relevant short book, a manager can basically pay its own fees with interest gained on its shorts. Finally, higher macro and market volatility creates an environment rich with opportunities for active trading. A hedge fund allocation in your client's portfolio makes sense in this current investment regime.